Have you ever looked at a company's earnings report and just felt lost in the numbers, trying to figure out what the real story is?
Oh, absolutely. Headlines can shout one thing, but then you dig into the details, the financials, and a whole different picture emerges. Sometimes, yeah, even a surprising one.
It's like trying to decode a message, isn't it?
Exactly. And that's what we're doing today. We're taking the sources you gave us, Opendoor's Q2 2025 earnings analysis, and we're going to unpack the really important stuff.
Right.
We've got this 5-part framework we use. It should give you a clear shortcut so you really get a handle on Opendoor's performance and where they're heading strategically, without getting bogged down in every single number.
Perfect. So today it's Opendoor Technologies, ticker OPEN, and their Q2 2025 earnings. We're going to cut through the noise, get straight to what really matters. Okay, let's unpack this. Now for slide 1, the at-a-glance scorecard. So looking at Opendoor's Q2 results versus what Wall Street was expecting, well, it was a bit of a mixed picture, really.
Yeah, that's a good way to put it.
On revenue, they actually beat the forecast. They brought in $1.567 billion, which was nicely above the consensus estimate of $1.50 billion, so a definite plus on the top line. But then you look at earnings per share, the EPS, they were just in line. Reported a diluted loss of 4 cents a share, which is exactly what analysts expected.
Right. Met expectations, didn't beat them there.
So how did analysts react initially?
Well, it seems kind of neutral, actually. I mean, getting to Adjusted EBITDA profitability, that's a positive milestone, no doubt.
Definitely something they highlighted.
But it was weighed down by some, concerning things, like a big drop in how many homes they bought and pretty weak outlook for the next quarter.
Yeah, the forward guidance wasn't great. So let's get a bit more perspective with the core GAAP numbers. That's generally accepted accounting principles. Comparing Q2 2025 with Q2 2024,
Okay.
total revenue, it was $1,567 million this year versus $1,511 million last year. So up, but only by about 3.7%. Pretty modest growth year over year.
Okay, 3.7% revenue growth. But look at the net loss. That improved dramatically. It shrank from a $92 million loss last year down to just a $29 million loss this quarter.
Wow, that's a big jump.
Huge. That's a 68.5% improvement. And diluted EPS followed suit, improved from a loss of 13 cents last year to a loss of just 0 piece and 4 cents this year. Again, about a 69% improvement.
Okay, that is a dramatic improvement on the bottom line. But you mentioned diluted EPS. That term can be a bit tricky. Can you quickly break down the difference between basic and diluted EPS, especially when a company like Opendoor is reporting a loss?
Sure thing. Basic EPS is, basic. It's just the net income or loss, in this case divided by the average number of shares out there. Simple division.
Got it.
Diluted EPS tries to give a more, let's say, conservative picture. It factors in stuff that could become shares later, like stock options or convertible debt, things that might dilute the existing shareholders.
Okay, so it shows the potential worst case in terms of share count.
Exactly. But here's the interesting twist. When a company has a net loss, like Opendoor does, often basic and diluted EPS end up being the same number.
Why is that?
Because if you added those potential extra shares when calculating a loss per share, it would actually make the loss per share look smaller. And the accounting rules say, nope, you can't do that. You can't artificially make your loss look better. It's called anti-dilution.
Ah, okay. So for Opendoor's loss this quarter, adding potential shares wouldn't have made the loss bigger per share, would have made it smaller. So they just used the basic share count for both.
Precisely. That's why both basic and diluted EPS came out at that $2 or 4 loss.
Right, got it. So those loss and EPS numbers improved a lot, like you said, almost 70%. But the revenue only nudged up about 3.7%. That's quite a gap.
It really is.
How does that happen? It suggests the improvement didn't really come from selling more houses or selling them way more profitably, right?
You've hit the nail on the head. What's fascinating here is how much power cost-cutting had on the bottom line, even with revenue only growing slightly. That big difference, modest 3.7% revenue growth versus that huge 69% improvement in loss per share, it's a massive signal.
The signal of what?
It signals major operational adjustments, belt tightening. It wasn't driven by strong top-line growth or better core profitability on the homes themselves. In fact, if you look at gross profit, that's revenue minus the direct costs of buying and fixing up the homes, it was basically flat. $128 million this quarter versus $129 million last year.
So the profit on each house sold didn't really change much.
Exactly. The real story, the driver behind that much smaller net loss, was a dramatic cut in operating expenses. They slashed them by 30%, down from $201 million in Q2 last year to just $141 million this Q2.
Wow, 30% cut in OpEx.
Yeah, that aggressive cost cutting was overwhelmingly the reason the net loss looked so much better. It was powerful enough to overcome even a slight increase in the number of shares out there. It's a story of pulling back hard, not surging forward.
Okay, that makes sense. Moving to slide 2, the engine of profitability. Let's dig a bit deeper into the margins because, like you said, that tells a story beyond just the sale price. First, the GAAP gross margin.
Right, a standard one.
It stayed relatively stable, didn't it? 8.2% this quarter, down just slightly from 8.5% last year, which I guess suggests they held the line on pricing and renovation costs okay.
Yeah, relatively stable there. It shows some discipline in the actual buying and selling process itself.
But then there's this other metric they use, contribution margin. It's non-GAAP, right? But management uses it to see unit profitability after things like holding costs, property taxes, insurance, utilities, while the house just sits there.
Correct. It's meant to capture more of the direct costs associated with holding and selling each specific home.
And that margin fell quite a bit, down to 4.4% this quarter from 6.3% a year ago. That's a pretty significant drop.
It is. And if we connect this to the bigger picture, this really exposes a core vulnerability of the iBuying model, wouldn't you say?
How so? Explain that divergence. Stable gross margin, falling contribution margin.
Well, the falling contribution margin points directly to rising costs that happen after they buy the house but before they sell it, primarily holding costs. Why? Because the housing market slowed down. Ah, so houses are sitting around longer.
Exactly. Sitting in inventory longer, racking up more costs like taxes, insurance, utilities, maintenance. And Opendoor confirmed this themselves. The percentage of homes they held for over 120 days, it surged. It went from just 14% a year ago to 36% this quarter.
36% held for over 4 months. That's a huge increase.
Huge. And it really highlights how sensitive this business model is to market speed or velocity. When houses don't sell quickly, those holding costs really start to bite into the profit per home. It's like they're becoming accidental landlords on a big chunk of their inventory.
Yeah, that adds a whole layer of cost and risk they probably didn't plan for initially.
Yeah.
So, okay, we have this GAAP net loss of $29 million, but then the company is highlighting this positive adjusted EBITDA of $23 million. Now, sometimes companies use these non-GAAP numbers like adjusted EBITDA, maybe to paint a bit of a rosier picture than the official GAAP numbers show. How should you, the listener, reconcile these two different views? What's the true financial health? That's a really important question, and yeah, there's definitely debate around non-GAAP metrics. So GAAP generally accepted accounting principles. Those are the official standardized rules in the U.S. Opendoor's official bottom line, according to those rules, was that $29 million loss, period.
Okay, the official score.
Right. Now, companies use non-GAAP measures like adjusted EBITDA because they argue it gives a clearer view of the core, ongoing operational performance. They do this by backing out certain expenses they see as, well, not part of the day-to-day operations, or maybe non-cash or one-off items.
Like what, in Opendoor's case? How did they get from a $29 million loss to a $23 million profit?
Okay, so the big adjustments were: they excluded $36 million in interest expense. That's mostly related to the debt they used to buy all that inventory.
Right, financing costs.
They excluded $13 million in stock-based compensation, paying employees with stock, which is a real expense but doesn't use cash in the period.
Non-cash, got it.
There was a positive adjustment of $7 million related to the timing of when they account for inventory write-downs. Management argues this aligns the costs better with when the homes are actually sold. It's a bit technical.
Wow.
And they excluded $5 million for depreciation and amortization, another non-cash charge. So you add those back, essentially, to the net loss.
So what does this all mean for understanding the company's true financial health? Should we focus on the GAAP loss or the adjusted EBITDA profit?
Honestly, you need to look at both. The positive adjusted EBITDA is significant. It tells you that the core mechanics of buying, fixing, and selling homes before financing costs and certain other expenses actually generated a profit this quarter. That suggests some underlying operational efficiency improvements. That's a milestone.
Okay, core operations were profitable on that basis.
But the GAAP net loss is just as crucial. It reminds you that the overall business, especially with its heavy reliance on debt, is still losing money once you factor everything in according to standard accounting. It perfectly shows the gap between, let's say, operational effectiveness and total financial viability right now. Okay, now to slide 4. Financial strength and shareholder rewards. Looking at Opendoor's balance sheet in Q2, it really screams defense. They're clearly bracing for a potentially long winter in the housing market.
How could you tell?
Well, look at their financial leverage. Their debt-to-equity ratio was 3.61 at the end of June. That's pretty high. It means they're using a lot more debt, $2.3 billion in liabilities, than shareholder equity, $631 million, to fund the business.
And that's risky, especially now.
It definitely introduces more financial risk, particularly with interest rates where they are. High debt makes you more vulnerable. Now, a key strategic move, which you see on the balance sheet, was cutting back hard on inventory. Real estate owned fell to $1.5 billion, down from $2.2 billion a year ago.
And that happened
Because they slammed the brakes on buying homes, purchases plunged 63% year over year. It's a real double-edged sword, you know.
How so?
Well, less inventory means less risk if prices fall further, and it frees up capital. That's the upside. The downside, it directly limits how much revenue they can possibly make in the near future, and we see that confirmed in their weak Q3 guidance. Fewer homes to sell means less revenue coming in.
Makes sense. Less fuel for the engine.
Exactly. And they were also proactive on the debt side. Back in May, they swapped out about $246 million of debt due in 2026 for new debt that matures way out in 2030. And they raised about $75 million in fresh cash at the same time.
So pushing out their debt deadlines.
Right, extending their debt runway, giving themselves more breathing room. It shores up their liquidity. All these moves together, cutting inventory, managing debt, holding cash, signal that management is digging in for a prolonged period of market weakness, not banking on a quick rebound.
And what about giving back to shareholders?
Yeah.
Dividends, buybacks?
It's not happening. It's crystal clear their focus is 100% on preserving capital and funding this big strategic shift they're undertaking. Absolutely no mention of dividends or share repurchases in the quarter.
Confirmed in the cash flow statement, too. No money spent on buybacks.
Confirmed. Zero cash used for buybacks. And that extra cash they raised from the debt deal, it's just sitting on the balance sheet, providing a cushion. It really underscores that defensive posture. Survival and transition first, shareholder returns way down the list right now. Finally, to slide 5. The road ahead management's outlook and key takeaways. CEO Carrie Wheeler's comments really set the tone. She framed the quarter as basically executing with discipline in a really tough market, while also starting this big evolution of their business model.
What did she actually say?
Well, on performance, she said, we delivered $1.6 billion in revenue and achieved our first quarter of Adjusted EBITDA profitability since 2022, even as housing market conditions continued to deteriorate. So acknowledging the profit milestone, but also the grim market.
Okay. What about looking forward?
Pretty blunt. Quote, we believe housing market weakness will persist, and we are not assuming any near-term catalyst for improvement. No sugarcoating there.
Right, and the strategy change.
She talked about that context. We are transitioning our business model during a historically difficult macro environment. The benefits of this evolution will take time to materialize. And then specifically on the new strategy, we are building by expanding our agent-led distribution platform. This is a significant evolution, allowing us to serve many more sellers and capture capital-light revenue streams.
Capital light. That seems to be the new buzzword. Less reliant on their own balance sheet to buy homes directly.
Exactly. Partnering more, buying less themselves. But as she said, it'll take time.
And that caution, that transition period, it's definitely reflected in the guidance for Q3, isn't it? That's a pretty stark outlook.
Oh, yeah. Projecting revenue to fall sharply, down to maybe $875 million, and flipping back to an Adjusted EBITDA loss of between $21 and $28 million. That really tells you the impact of buying fewer homes is about to hit the top and bottom lines hard.
So let's pull it all together. What are the key takeaways for you from this quarter?
Okay, first big one. This was a profitable contraction. Yes, they hit positive Adjusted EBITDA, which is notable, but they did it by deliberately shrinking the business, slashing those home acquisitions by 63%. It was about profitability through contraction, not growth. And the cost is that bleak revenue outlook for the rest of the year.
Right. Second takeaway for me is this major pivot from disruptor to partner. The tough market really forced their hand, accelerating this shift away from purely capital-intensive iBuying. They're moving towards being a platform, working with agents, going for that capital-light model. It's a fundamental change in identity, a long-term bet, and yeah, results are uncertain near-term.
Third, the margin story reveals the market pain. That stable GAAP gross margin looked okay, but the contribution margin falling significantly. That tells the tale. Homes sitting longer, holding costs piling up because the market is slow. It perfectly illustrates the model's sensitivity to market speed and exactly why they're pivoting to something less capital-intensive and less exposed to holding risk. It's the hidden cost of a slow market becoming very visible.
Definitely. And the last one for me is they are clearly battening down the financial hatches. All those balance sheet moves, extending debt, hoarding cash, cutting inventory, and importantly, not returning cash to shareholders, it all points to a management team preparing for a long, tough slog in housing, not a quick V-shaped recovery. It's pure defense.
Absolutely. So wrapping it all up, Opendoor's Q2 results. I'd call it a story of disciplined retreat in a really brutal market. That headline beat on revenue and the inline EPS, even hitting that adjusted EBITDA profit, it wasn't about growth picking up, not at
Oh,
all.
it was the opposite.
It was a result of a very deliberate defensive strategy. They widened their offer spreads, meaning they offered less for homes to protect margins, and the direct consequence was they bought far fewer homes. That 63% drop in acquisitions and the grim Q3 forecast show that trade-off starkly.
Yeah.
This quarter really feels like a critical inflection point, a necessary transition, as the CEO put it. They're consciously moving away from the pure, capital-heavy iBuying model that defined them towards this more collaborative, capital-light platform idea. The results aren't really a victory flag. They're more like a testament to survival tactics as Opendoor tries to navigate this historic downturn while fundamentally reinventing itself on the fly.
That's a great summary. Really paints a clear picture of a company in deep transition. So thinking about that, this whole capital light pivot, what does it really mean for the long-term future of companies like Opendoor? And maybe even for the wider real estate market. Is this the new playbook for survival in uncertain times? Or is it just a temporary detour? Something to think about. And just a reminder for everyone listening, this deep dive is for informational purposes only. It doesn't constitute financial, investment, legal, or tax advice. Always, always do your own research and please consult with a qualified financial professional before making any investment decisions. Also, this report was generated using an artificial intelligence model, integrating data from official earnings releases and public market data. While it's designed for accuracy, we always recommend independent verification. Like and subscribe to stockanalytics.ai. YouTube channel, members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.